I'm going to allow each of my panelists to introduce themselves. So we'll start with Ryan, and we'll bring it this way.
Hi, Ryan Peabody. I'm head of data science at Starwood Capital.
Stefan Martinovic, head of data partnerships at Placer.ai.
Geraldine Guichardo, I work at JLL, and I head up the global research for the hotels practice, and also head up the living research across the Americas.
I'm Josh Harris. I am Vice President of Investment Strategy for Skanska USA's Commercial Development Operations. So this panel, we're talking about essentially how we're going to use technology data to essentially make more money, leveraging obviously meaningful return on investment, however we wish to equate that, be it on a project or a firm level. And I couldn't help but notice, obviously, this is a very interestingly eclectic group of panelists. We have one from sort of called private equity world, brokerage world, and actually the data world, and then myself from the development world. So I kind of just an interesting lead-off question. I think that we probably cover a wide gambit of what everybody in the room is somehow involved in personally, one way or the other. When you hear about data, I think we all have roles where we're sort of asked to either opine on data or sell data or provide or insights from data. What does that actually mean to you in your business? And like if you had to explain yourself about the data strategy that you're behind, what does that actually mean? And we'll start here.
Sure. So in my role, I track a lot of the capital markets transactions and whatever is taking place in the capital markets world as it relates to the living space and hospitality. What that actually means is transactions, right? So the buying and selling of property, cap rates, but more importantly, also the fundamental side of data, right? How are properties performing? Because obviously that then impacts how the appetite, right, for some of these assets. And so when I think about data, it's tracking all of that, right? But also what insights and what stories can we tell from that data? And that is where the real value that comes from teams like mine, where you can look at a number and it can say, yeah, rents are increasing 20%, but there's so much behind that, right? And so there's always that story behind the data that I find very important as well.
And Stefan, when you go, you should probably describe what Placer.ai has in terms of data. I give you permission to please give that little understanding point so everyone gets it.
Yeah, let's see if I can remember. So yeah, Placer.ai is we're a location intelligence platform. So at its core, we are aggregating large volumes of anonymized cell phone location data and using that to understand patterns of where people go over time, what drives them there, what are their motivations, who are they, and all different other sorts of characteristics and aspects about their behavioral and consumer patterns. So with that in mind, my path to kind of being in the data space has been kind of circuitous. Started in real estate development, launched a data company 10 years ago, came back into real estate, and now I am a part-time real estate developer and full-time data guy. And I'm a believer in it because I've used this data, Placer's data specifically, to make investment decisions that have proven to bear out, where you couldn't be fully informed and make you basically couldn't make such an informed decision if you didn't have access to this kind of intelligence and information. So quick example, during the height of the pandemic, I'd been going on, I guess, a year at this point of trying to find property outside of New York City to do more of a rural development with a couple of partners of mine. And of course, March hits, the pandemic shuts everything down, it's winter in the mountains, nobody's really around, and we see this incredible property and we say, wow, this is something else, but the world is changing, and is now the right time for us to make this investment? Is this the right town? How will we know? We couldn't really tell, by seeing foot traffic of people on the street because no businesses were open, it's cold, and it was off season. And so basically what I was able to do is use Placer to run a report and to understand that there were large volumes of people that were coming from New York City, driving 50 miles up the thruway, and actually spending longer periods of time where they used to come just on the weekend. Now they were setting up full-time occupancy there, and there was an increased demand from a lot of very well-heeled people to buy and occupy homes in the area, but very little, if any, new supply coming to market. So fast forward a year, things have reopened, things are kind of starting to regain a sense of normalcy, and seven out of the 10 vacant spaces on Main Street that, were retail establishments got filled in that period of time. So, we saw the demand, kind of in a way that, almost gave us really X-ray vision to understand what was going on, even though we couldn't see it with our naked eye. And then, once the fog lifted, all of that, realization ended up kind of paying off and drove our property value, through the roof in a very short period of time. So, these are the kinds of things and unique use cases that you can really unlock, by using unique data sets and applying them in a value-add way.
So, and forgive me because I'm pretty new at Starwood. Data science for us is about a 4-month-old initiative, but at least
Are you the first in that title, out of curiosity?
No, they tried this once before. Okay. I'm going to stay diplomatic. Okay, so when we think about data strategy, and by we, I really mean me, it's kind of two phases. And the first is exactly what Stefan's talking about, is bringing in additional alternative data into that process, understanding foot traffic, understanding migration patterns, understanding kind of the whole location ecosystem that exists around real assets. But the second part is actually cutting those down. As we as a field on the investment side try to become increasingly quantitative, it can be very tempting to just throw on as much data as possible and try to tell some story. But then we're kind of doing the same thing that we always were. We're still just shooting from the hip, and we're telling a narrative and not necessarily correlating that to anything. So our data strategy, my role with data at Starwood is to drive value, and that can be done on the asset management side, either by cutting costs or expanding revenue, or on the investment side, by allowing us to make better decisions, by allowing us to identify mispriced opportunities or know where we can lean in a little bit more. So that second part, honestly, is just to be a little biased. That's kind of my priority in our data strategy, is making sure that we're thinking about data in a way that matters and actually drives real return on investment.
That's very interesting, and I actually, as I was thinking about what my own answer to that question, and I can't say, Ryan, I kind of feel like I'm in that same world where, Skanska has been, it's a large multinational development and construction company. So they've been doing these things for a while, but we've only been doing development as a principal developer in the United States for about 10 years. I joined 2 years ago, 2019, like just perfect timing, good number of months before the pandemic. I got to fly around, meet everybody, fly over to Europe, and then of course, I just still remember one fateful Monday morning in March of 2020 where I'm standing at the JFK airport getting ready to board a flight for LA, and I'm told we have been put on a corporate travel hold. And I literally call in to one of our home offices, talk to an exec assistant saying, well, I'm at the airport, what do I do? And she said, well, probably you should just take an Uber back home. And little did I know. And what was interesting about that is my role as sort of as head of strategy, data was always a big part, just because, a bit of my background, I have a PhD in finance. I came from the academic and consulting world. They hired me on because they wanted to have, more firepower in that place. They really did not know what you could do with it, but they know that they weren't doing much with it, right? It was sort of an interesting exploration in addition to all this corporate strategy stuff. So here we are, all of a sudden, I'm 6 months into my job, COVID is hitting. I'm now in this weird work from home world, and all of a sudden, it feels like my own personal importance jumped up, because all of a sudden they're like, well, what's going to happen? What's it going to be? What's this? There's these now bombarding of questions where I think before data was like pretty charts they could put into investment books. I mean, they would look at it. Obviously, they wanted to know what they could know, but it was always, I think the decision was pre-assumed, like, this is a good deal, it's going to work out, right? And I'm sure Starwood, and I'm sure a lot of the JLL clients, right? And, and I've done research work with brokerage, it's research and data was always kind of like, let's prove it, but let's be honest, a lot of people thought the decisions had been made. I mean, and that's something that all of a sudden they're like, what can we figure out? What can we know? And even my own budgets for getting data approved seemingly went through a lot faster all of a sudden because there was just a lot more angst. And so I suddenly realized that my own role with this would be, they were actually more interested, because just kind of like what Stefan was saying, right? You're like, well, how can I assess this a little bit differently? So kind of giving you my own answer to the question I'm going to ask, and I know, so I'm not, Ryan, you can talk about where you were or not, I know you weren't there for 2020, but you can imagine what it was for your company or answer however you choose. But for everyone, how do you feel that the pandemic opened up did you guys have my experience where suddenly data and research questions were, I always like to joke that, the world's in trouble when the economist becomes an interesting speaker all of a sudden, right? That's never a good sign. When you want economists to be very boring speakers, that's usually a good time. So, but do you feel that this has reopened, like the budgets, the attention, the mind space of the CEOs, the investors, the investment committees, and what have you seen has changed literally because of the pandemic that you think won't go away, or do you think it will go back to normal? And Geraldine, go ahead.
Sure. Similar experience to you. I was inundated with questions like what's happening, what's going to happen, how does this compare to the previous downturn, how bad is it? And funny enough, and maybe I'm oversharing, but I noticed the importance of research when the team had to downsize and no one on the research team got let go. But there were plenty of brokers and other folks that just were, for whatever reason, and I'm like, oh, okay, I guess we know who's important to the team right now. So that alone definitely was a pivotal moment in my career personally. And then going forward, I think the expectations have been enhanced, right? Now that we're operating with more data at our fingertips, understanding what markets it may lead us to invest in or where we shouldn't or whatnot. I do think this is a new awakening in a sense. There's definitely going to be people in the industry that kind of want to revert back to, well, this is a gut feeling. I've been doing this for 20 years. I know where the capital should go. And there's a lot of intelligent and more sophisticated investors, as my panelists here, Starwood Capital and others like them, that are creating data science his team. So it's a new reckoning, and I definitely feel like this is the way forward.
I guess my response to that would be it varies from organization to organization, because I actually had a completely opposite experience. So I worked for a family office, and they had brought me in, I want to say 2018, to kind of like figure out all this data and tech stuff. And so, it took me a good 6 months to sit down in enough meetings with our, senior leadership to kind of like extract from them forcibly what are the things that you actually look for and care about in, a market condition, in a location, in a particular asset. And, we came up with this, really comprehensive, 100 data point list of things. And then we went about building a model and then applying that to all different sorts of locations. So we felt like we were pretty equipped. Of course, at the end of the day, that ended up being total overkill because, Josh, like you were saying, the decision was already made 90% of the time before we walked into the room and made the presentation of what the data actually told us. Or it was so much back and forth of understanding the methodology and the rationale of what the model was telling us that it often got too confusing in order for us to really rely on a regular basis. And in a family office in particular, there's so many different motivations and tax considerations and things like that might not otherwise apply to someone who's coming in with a clean slate. But I worked through that, and then basically once the pandemic hit, I was, the priorities of the organization totally got upended. So we had this great data model, and we were, now starting to look at things like, okay, where were outbreaks happening? Where are there restrictions? And really we were trying to outrun the rest of the market in our ability to find, absorb, and process a lot of this data so that we could actually get a leg up on the competition. So if it looked really bad in the news somewhere and everybody was selling with fear, we could go in and maybe pick up assets on the cheap. Well, we ended up not even really getting the opportunity because everything was so focused on damage control that I found a shift in the organization's focus away from research and away from all the hard work that we had done in the couple years prior to kind of figuring out, okay, well, how do we figure out how do we better negotiate with our tenants, on all of these, hundreds of rent relief requests. And everything that I was doing kind of got cast to the side, and I said, I feel like I'm the one who actually has a real, data-backed viewpoint of what's actually going to happen, and I don't see anyone even asking me these questions. And so maybe that's a sign that I need to go and make a career change, and so that's ultimately what I did.
So during the pandemic, I was doing basically what I do now, but at Blackstone. And I can tell you that internally within Blackstone, the demand for data during the pandemic just skyrocketed. I hate saying it, but it was one of the best things that's ever happened to me professionally. We were sitting on top of these assets, like, and for us, because we had a huge portfolio to manage, the focus initially when deal flow just completely dried up was to just understand what we were even sitting on top of. We realized we didn't know who our tenants were. We didn't know if they were going to make rent. We didn't know what was going to go on with anything. And then when we started looking at acquisitions again, I mean, we previously were buying office buildings in big cities, and we had no. Remember last summer, like it was insane. It felt like we had no idea which asset classes were actually going to recover from this. And we were sitting there watching like the tech behemoths make these. I mean, Facebook took 800,000 square feet of office space right around Penn Station in the middle of 2020. We didn't know how to make heads or tails of that. You want to talk about like an old school narrative. You have a company that was at 0% occupancy in their offices, taking almost 1 million square feet of space. We didn't know what to make of that. So at least internally, I think the pandemic, for investors of that scale, at least what I've seen is that we have very much embraced kind of quantitative analysis and alternative data as not necessarily something that we need to be doing now, but something that we need to build into our systems and kind of future-proof ourselves.
Yeah. It's pretty interesting because I think that, everybody would, when times are good, data and then, risk management, all these things, it's usually, I hate to use the word check mark box, but I know in bank underwriting, there's a lot of pages that get added, things that are there, in fact, a lot of this came in after 08, if anyone was in business back then, where I remember this, because 08 was a big one for my career, because that's when made me go get a PhD, because I realized I was trying to do real estate financing work, and I'm like, man, there's no deals happening. I was here in Florida, and I realized, like, this ain't gonna happen. So that's, and that was early 08 before it really hit the fan, and I remember, like, after that, it feels like every, all these consultants that do all the ratings for the pension funds and all this, who obviously rate the funds of like Starwood, et cetera, like they, research methodology, ideation suddenly became a scoreable item. So all of a sudden they had to, prove that out, right? You couldn't just say, hey, it's, we've been doing deals for X years, so we just know how to, we know how to smell them out. You couldn't get away with just saying that anymore. And that, so it's like all this infrastructure got built, and then obviously the COVID, the pandemic was sort of the first testing of it, and that's kind of what you're describing. And I think the family office, it's everybody had a different reaction a little bit by where they were placed. What I'm kind of curious about now that trying to say is the pandemic over or not, I think is one of the most overfraught, I hate to say even getting political type thing. We're in the free state of Florida where I feel like it's been, I'm from Florida, I have a lot of friends and family here, worked here a long time, and it's like, oh, COVID, you guys are still talking about that up in New York? Oh, that's cool. And even when Florida goes from being, whether it had the highest number of cases down to the lowest number of cases, where I think it might still be today, I don't track the data, that data that close, but this whole question about coming out of this, and now we're like, I think all these debates, and I'm just going to give you my snippet of the news, and you guys I'm going to get your reaction of how data will solve this, or get ahead of this, or how your firms will interact. But, are people going to, to me, there were two big debates, and they're not independent of each other. They are independent, but they could both move in their own directions. One was this whole urban versus suburb, right? And you were, I think, Stefan, you kind of hit the whole, like, boy, living in a really tiny thing in New York City really doesn't seem fun. Let me get back up to, like Woodstock or whatever, right? Suddenly that was a big, interesting thing. And, I live in Westchester County, New York, and boy, if our home prices didn't skyrocket overnight type of thing as a result. So that was one big debate, just the city, was this finally going to do the de-urbanization after literally decades of mass urbanization? Then there was this whole other interesting but kind of related thing about, well, are people just going to flee the great state of New York and Connecticut, New Jersey, and all of its taxes and funness otherwise, and come to Florida and Texas or the Carolinas or Nashville, or, you can add your kind of secondary southern Sunbelt type of city to that. Same thing for, California. So those are the two big locational questions. So I'm kind of curious. Location data is a very big part of real estate data by necessity. It's a location-driven business. So I guess I have twofold questions, and you can answer which one you think and both applies to you or not, but what data do you think is going to help investors and developers who want to make capital decisions figure out which urban versus suburbans are good, which secondary versus primaries are good, and also to the extent is, how do you predict this? How would you go about trying to leverage that data to actually have a predictive response to it? And actually, Stephen, I want you to lead off first, since you're the...
Yeah, I was gonna take the mic if you didn't give it to me, Josh. But
I'm not surprised.
Yeah, no, you're right. I mean, look, you mentioned the word, you mentioned the phrase, what are people gonna do in X situation, right? That's what we do at Placer. We don't look at properties, fundamentally for their square footage or their foundation type or column spacing or any of those other things. What we're doing is we're trying to understand people, right? And if people are not going to an office building, those leases will not get renewed, there will be no revenue, and the building is worth a lot less money. It's the bottom line. And if there's not spatial demand for people to live in a certain place, then prices will go down because of their supply that's being, if there's an oversupply relative to demand, and obviously market economics are going to dictate that. So, I mean, what we're, our business has grown by leaps and bounds, and it's really because people have realized that, I might think I know the bricks and sticks side of it, but if I don't know, the story of how people are going to interact with this place, and if people are going to change their behavioral patterns in such a way where it makes these places more relevant again, then, I'm really in deep trouble. So, we've been doing is, studying, how people are engaging with retail, how they're engaging with the workplace. Are they coming in less days? Are they showing up later? Are they leaving earlier? Are they taking transit? Are they driving? We're really kind of trying to recreate the entire picture of what is the beating heart of all these different cities and towns across the U.S. through the eyes of, the collective population that's actually, engaging in commercial activity and, exhibiting this residential demand. So, what we do at Placer is, I mentioned, aggregating all these mobile device signals, and by doing that and monitoring these behavioral patterns, we can understand where people live and where people work. And if those patterns are changing and they move from point A to point B, we know. And so, what I saw by looking at a lot of our data, alongside some of the stuff that we put together and trying to kind of predict market suitability for a lot of the investment strategy that I was putting together at our, at our family office, is that it actually is far more logical than you might think it would be, to see demand go down to the Sun Belt and a lot of these other places, because ultimately, there was an incredibly high correlation between low cost of living versus high quality of life. Period. If you can move somewhere and still work, which obviously COVID and work from home and all these trends, that got accelerated, enable people to do, people gravitated to where it was warmer, cheaper, and more suitable for whatever kind of lifestyle they wanted to live, as opposed to, like you said, being crammed into a box with in an apartment with a window that doesn't have natural light, right? So hard to say that people would want to do that unless there was some sort of social gravitational draw, and in fact we saw quite the opposite.
Well, I totally agree with what Stefan was saying about focusing on people. I think it's about time that real estate adapts to the consumer and consumer behavior. And I think hotels have been at the forefront, in my opinion, because the consumer is always top of mind, and other real estate spaces have been catching up or are catching up. But on the location point, I would say that niche markets and neighborhoods and understanding the demographic and economic dynamics within the neighborhoods is especially important. So as an example, if you think about Chicago's in the news a lot for a lot of negative things. I work at the Aon Center, and I've been going into the office maybe twice a week, and foot traffic is awful. Occupancy is very low in the building. However, if you focus your attention on the West Loop market, where there are some offices there, they're leasing up at a faster pace than the overall market. The newest luxury high-rises for multi-housing are in that neighborhood. And if you look at the area, all the newest restaurants and bars are in that area. So people that live there literally live by the motto, work, live, play. And so if you're an investor and you're just generally analyzing the market and not really focusing on those nitty-gritty details by neighborhood, you could be missing out on an amazing opportunity. So location, but even more granular, I would say, is of utmost importance in today's market, where it's easy to say that all the Sun Belt markets are great. New York, Chicago, they're bad, you know? So that's my 2 cents.
I guess when I think about like kind of coming out of the pandemic, though, if we'd had this conversation in 2015, we would have been talking about the same places. Like, look at the winners coming out of the pandemic. It's what? It's like Phoenix, Austin, Nashville, Miami. Like, that's, and we're all relatively negative on like San Francisco and New York. We were singing the same story like a while ago, and I'm not trying to like oversimplify this, but like it in my mind at least, it caused more of an acceleration of existing trends. There weren't that many fundamental trends in real estate that were completely turned on their heads. And even when you look at like, you know, yeah, New York, you know, we saw disruptions, especially in the Northeast, when you look at like, say, the price of like single family homes in Westchester, or even like Southern Maine, like kind of weird short-term dislocations. But if we go down to the Sun Belt markets, everything starts feeling a little bit more normal. Like, yeah, it's really hot and frothy, but like office is doing well, even retail, like aspects of retail are doing well. Go try to buy a grocery store in Austin, Texas. Tell me what sort of cap rate you're going to pay. Like, it's
try to buy groceries in Austin, Texas.
What?
So
yeah.
Just try to.
But I guess more what I'm saying is like, it is just Stefan's point. It's a supply and demand problem, and I think we are like a relatively inertial industry. Like these trends were existing beforehand, and I would just emphasize, you need that local knowledge to actually make the right bet. Like, you know, no one here is really making huge contrarian bets at the end of the day. No one's really like going all in on shopping malls in Minneapolis, unless I'm talking to the wrong people. But like, yeah, if you can identify like those little pockets in Austin, those little pockets in Phoenix where there are mispricings and where you can see that strong growth and strong interaction, that's where you're actually gonna like, that's where you should focus.
Yeah, right. You know, I'm laughing a little bit because when Ryan started talking about that, I said that literally was one of the points that I kept making on a lot of my internal calls in the midst. You know, while I'm now making Zoom or actually we use Teams, Microsoft Teams. We don't use Zoom. That's like a bad word in our company for some reason. But so on our Teams presentations, and I always would make this statement about like, be very careful about just believing like there's been a paradigm shift or a new trend as a result of one of these crazy things. And I would, you know, and at first I'd say, like, when people talk about moving moving from New York to Florida, I hate to tell you, that's been happening a really long time. I mean, the reason I was born in Florida is because my dad was one of those people who flipped out of New York in the 70s. I mean, like, I understand this one very well personally. And as I'm seeing all these news, like, that's not new. And I mean, when I think about Starwood, you know, Miami Beach, that was that was a move for lots of reasons that we all can understand. And I always would point out, after 9/11, there was a thing, no one's ever going to build skyscrapers again. Well, that, New York and pretty much every other city will prove that one wrong. After 2008, people weren't going to buy houses again. The millennials were never going to buy a house. And I just literally saw a news story like yesterday about how millennials are now blamed for the extremely tight, overly expensive housing market. And they literally said they were never supposed to buy a house, and yet here they are bidding it up to the skyrocketing prices. And, and I always think that it's a limitation of data that this is something I learned very, very personally in a PhD program where we're somewhat of we have a lot of finance data, which is about as infinite as possible. But in the stock market financial world, there was actually, if you go back to certainly the 90s when computing was finally getting good, and then there was computing is going to get so good that you're going to be able to crunch all these stock prices, and you're going to have predictive models, and there's lots of hedge funds and people that grew up and said we're going to exploit this and the hyper trading. And I don't know if anyone's ever really realized, but in the last certainly 10 years, when computing has gotten so good, first of all, pretty much everybody with a laptop can probably have about as powerful of an algorithm as anybody else, which takes away the advantage. And before you knew it, everyone realized, well, you know what? Data and big data isn't going to help me make higher stock returns. In fact, if anything, it's pushed that you can't even argue that the people who do index investing aren't the smartest. And I think about in real estate, where we're the opposite. Like, we generate data points like maybe like 0.0001% of what financial markets do. And my first guess is that, like, boy, it's going to be hard to find it. But that also means that if you find a signal, it might be a lot more meaningful. And I think, Ryan's like, that's my pitch for my budgets and data and everything else need to go up. But I want to know from everybody's perspective, what is sort of the most unique type of data that you think a real estate investor, developer, asset allocator, lender can really use to actually get ahead on trends that I'm not going to say it's going to lead to pure outperformance, but what is that best type of data you think you're the most excited about? And Geraldine, I'll let you go first.
It's a good question. I'm still thinking about it. I would kind of divert back to what I was saying before on the location. I've been working with a couple of brokers based out of Chicago, again, trying to pitch the sale of a luxury high-rise. And when you stack up Chicago against other major markets, it's just a tough story to tell. So they bring in research and they're like, can you help us think more creatively here? And so what I've been able to do is, again, like focus on the smaller niche markets and see what the positive trends are there. And then sometimes showing like the growth in rent, for example, that smaller submarket has been able to achieve over relative to some of the greater markets, and that's kind of been an angle that I've been able to use. But it's really, again, thinking about like the people movement and where that would be going next, and trying to come up with something smart there. But it's really tough, I would say, in today's market.
Can I say mobile location data again? So, and you know, I'll catch that by saying it. You know, the mobile location data set is an extremely powerful one, right? This is all about understanding where people are moving, just like you were saying, Geraldine. Like it's a matter of knowing like what you're looking for and how to apply it, right? So, you know, even to touch on the point that you were making before about like getting the granularity of the data right, because just saying that New York is doing poorly doesn't actually tell the story, right? Because if you look at some of the individual large multifamily complexes or neighborhoods, I mean, it's a wildly different story, from one side of the island to the other, wildly different. If you're looking at the theater district and Broadway, and you're looking at physical occupancy of a lot of the new high-rise Class A rental buildings, let's say, and on 57th Street, you're going to see that like there's not a lot of people there. Then you look at Stuytown, where you've got a lot of like younger people doing shares that want to have a social life after being trapped in their parents' basement for the last 2 years. There's occupancy at levels that I've never seen before, right? And like we're talking about the same city in the same county in the same city, a couple zip codes over is all we're talking about. So it's really knowing like, what lens do you really think you need to look through, and then like, working backwards to say, okay, well, what data is going to get us there? And I've, I'll admit that I've made some mistakes in, my own life trying to figure out what kind of newfangled crazy data set can I get that nobody else is looking at, that's gonna put us over the edge. And so we looked at stuff like light pollution and all the sorts of things like this to, get a sense of where there was urban growth happening. And honestly, like, it told the same story as a lot of stuff that like is a lot more fundamental and basic that everyone has access to. But, I dove into this mobile location data thing because from what I saw, it served 50 different use cases that I had if I just was able to tweak and reform it a variety of different ways.
There is going to be a limit of kind of what I can say, but in general, if you kind of wanted a good shopping list, I would start by looking at what any consumer pod in the public equity space is buying. Like if you just called up like the PM at Citadel who covers consumer, find out what his team takes in, that's not a bad starting place. And then the bigger thing too, I think, is I never start with the data set in general. We always try to start with the actual hypothesis and think out what it is we're trying to test, and then find a data set or data sets that cover that. And like a lot of times they're pretty simple, because if you can identify which one solves the crux of your problem, that's the one you want to go with, rather than kind of coming at it from the other way and getting all excited about like, oh yeah, we're going to use like active radar to like look at this thing over a building because that'll tell us something about like the materials they're using. Yeah, that'd be really cool, but I don't really know what I would do with that.
That's a good one, and I think that the question, and you, Ryan, you would have been great in a PhD program. What's the question before you start looking at the data? Because I can tell you a lot of people will get data, then find an interesting question. And I'll be honest, a lot of academic research gets published with sort of, let's start crunching through the data and find an answer to a question and then write the justification. That's dirty little truth about a lot of that world. I remember, but it reminded me of one of maybe the best questions I ever got asked on a panel format thing. This was back, and I was still an NYU professor. I had not joined Skanska at the time. And I was in this, we were discussing, and if anyone knows Jim Costello with Real Capital Analytics, he and I are really good on panels because we kind of go back and forth. And I used to be very in favor of like the secondary market hypothesis, and he was kind of a New York City maximalist. I don't want to speak for him, but that's sometimes how he would present. And I started talking about Denver and relative trends, and I get this question from somebody in the audience and says, how do you predict the next Denver? And I kept thinking that is like the best question ever, because if you could have, you can think about, if anyone thinks about the data trends of, the valuation, everything in Denver, just imagine if you could have arrived 10 years earlier. Imagine if you could have arrived in Seattle just 10 years earlier, right? And the reality is probably 10 years ahead of Denver being Denver, Seattle being Seattle, Nashville being Nashville, and God knows Austin. I have a lot of personal thoughts on that one. But you would have actually seen the early warning signs. They weren't secret, and that's the interesting thing now, whether you could have amalgamated them. And for me, and now that I'm at Skanska and we're looking at, we know the markets that we've done really well in, and we've known where we've struggled at times, and for us, we find it interesting because we do both office and multifamily, and often in very mixed use. Like in Boston, we literally have office buildings next to an apartment building that we did. We find that there's an interesting connection with the tenants that we want to house in our apartments, which tend to be obviously higher end renters that we were building high end Class A properties. And the thesis is that that's the same type of person, if not literally the same person, although how true that is, who knows, that's going to work in the office that we're going to build in the same place, right? So it's sort of like, it was sort of a realization that maybe one answer cures them all, if there is such an answer. And, for me, realizing that where people want to be, those be it the tech, media, there are all these very interesting sort of items. If they go, well, we learned that the accountants go with it, the certain law firms go with it. There's just sort of this, this sort of interesting, the co-location model is very unique. And I'll tell you that I will mention one type of data that we're experimenting with. I don't want to say that we've cracked the magic code yet. So, and if I did, I kind of like Ryan, I couldn't tell you, I guess, but it intrigues me just because I do wonder if it will play out is some of the social media, like meta tagging data, which I think it's similar a little bit with the location from this. I mean, it's a similar process, I think, to what you guys at Placer with cell phone data. I mean, it's you're sort of looking at an instantaneous read. And what I found interesting about some of the social media data is that, like, now look, trust me, if I'm going to talk about this in my company, we have a lot of young people like, oh yeah, I tag, all the stuff. I take all the pictures of my food and post this. Even one of our executive vice presidents, apparently she has an incredible following on Instagram from like food and travel photos. And she didn't really realize that when she did her Instagram, that it was like fully public. So like, but she got popular that way. I mentioned it to other people like, well, I mean, I take my wife to Applebee's on a Friday night. What am I gonna, So it's limited in that who's checking in, right? I mean, I'll be honest, I'm not super old, but I do not check in at things. If I go with my wife, maybe if it's her birthday, we'll get a Facebook post out of it. But it occurred to me that there was this whole generation of people that are really living their lives in this way. Now, I don't know if that trend's gonna continue forever or be as predictive, but at some point, what I'm realizing is that places like Brooklyn, like my dad was born in Brooklyn, and he lives in Florida now, and I try to explain to him that parts of Brooklyn are more expensive than Manhattan. He thinks I'm totally insane. But the reality is, it was the hipsters in Brooklyn that started making it cool long before any of the corporations started signing a darn lease, and before the big developers started building skyscrapers to the sky. So I'm looking at ways to see who's that emergent tenant, who's moving around. This is the multifamily track, right? People who are moving into your area, I mean, I actually, and I put this out as a challenge to our whole industry. All of the data we need to know is probably in the lives and the mouths of the people that we are already calling customers and clients. But do we know how to actually access that? And I think that that's one of the challenges. So I do want to, I do kind of want to be very, kind of move this to one of the questions I have down here that I actually kind of curious to get everyone's almost a quick take view on, because we don't have a ton of time left. But affordable housing, right? We all know this is like a massive challenge for cities. We were talking about, we had our pre-table, we were talking about the various regulations and the way that cities have done not such a great job at managing this. But Do you think that there's a way that we could use via our use of data to present, be it to the public officials or to increase or to change our own investment decisions? Is there a solution here, the way the data can actually change the way that we think about affordable housing or we put affordable housing? Is there something there that we should be looking for? This is a little bit of a pro-social, but also please keep it business-minded response. And I'm going to throw it to Ryan first, actually, because it...
Okay. Well, first of all, shout out to our own portfolio. I think we are the biggest affordable housing landlord in the country. But honestly, I think the biggest thing that we could show to people is to get cities to understand, frankly, that development is not necessarily the cause of economic distress. No, I'm serious. But if you look at like city council meetings,
glad you said it, not me.
There's an absolute phobia of development, and kind of the math problem that I have yet to see someone bring is to show that our industry follows trends. There are very few successful ground-up developments, I think, that I've seen where someone comes in and creates a neighborhood that no one wanted to live in before, and they just, like build it, and kind of if you build it, they will come. That doesn't actually really happen. We chase where people are already going, and I think if we could effectively show, and again, this isn't terribly exciting data, it's pretty fundamental data at the end of the day. If we could successfully show that those pricing pressures are already going up and that there is a degree of alleviation that comes from increasing your housing stock when people are looking at coming into a neighborhood already, I think that would be really powerful and really meaningful.
Yeah, I can pick up on that. I think that that's really, it's a really valid perspective, and I think that the displacement pressure is really kind of like what goes along with affordable housing. Like if there's a lot of demand for this area, where do the people that live there now that pay a lot less, where do they go? Right, and so now we can track that and understand that, and try and front run it a little bit and say hey, well we are short however many thousand affordable units, let's put together a government program or something along those lines in order to actually fill that gap. I would not say that our government entities have been particularly great at executing on all of that. And look, honestly, maybe whether this is a tech solution or not, it's just that this stuff is just so complicated. It's so complicated to build affordable housing. If you've ever, put together a 221D4 affordable housing tax credit bond offering, my God, it's mind-numbingly complex, and there's certain economic situations which are advantageous to people that maybe they want to own the asset over the long term and get a steady amount of a little bit of cash flow over that period of time. Great, but that's not the objective of every landowner and every investor. So it's about kind of understanding where do the economics of owning the land, the tax base, and the cost of construction really is going to be the biggest driver of being able to execute affordable housing. How does that come together in a way that actually makes it viable for more housing production to occur? And maybe it's not a data problem. I think that if we can figure out ways where we can value engineer the construction costs and the timeline associated with that, which is what you're starting to see, modular and prefab, construction techniques really kind of start to tackle. Those techniques were, originally applied, in situations where you have public financing because you've got to pay higher on-site labor rates, right? So when you back that out and you say, well, look, it's only going to take us 6 months to build this building on site and the other 12 months in the factory, that is a game changer for the economics, right? And so it's going to be a combination of all these things, and maybe there's a blockchain tokenization aspect of it that I'm not thinking of in there as well, but it's not one solution. It's going to be a combination of a bunch of different things.
Yeah, not much to add after what they said, but in a sense, to summarize that, it's just thinking outside the box and being more creative and open to listening to the data, understanding that construction cost is not the only issue, right? And in my opinion, it's more so on the government, right? Simplify the process, use technology to make these forms easier to fill out, and collaborate with tech startups who are willing and able to help. There's a bunch that are out there already. And on the technology side, on the consumer side, I feel like they can also become more intelligent as to what's out there. There's a ton of apps that play in the co-living space, right? That will buy up single family homes, subdivide the space, and for $500 to $600 a month, you can have a place that you feel some sort of respect of living in, right? It's not like a hole in the wall. There's running water, washer and dryers, internet. So in a sense, I feel like technology can definitely help on all levels, right? With the government, owner-operators, and on the consumer side.
It's all good answers. One thing I want to add to it that I think that the data is very clear on this from some of this back to my academic days of seeing studies but also my own work and anecdotal thing is that like in some communities, there's a fear of we'll just use the phrase gentrification because it's understood, even though that's maybe not always accurate for the sites, whatever. But in most realities, when you look over any period of time, when you have redevelopment, and certainly you bring in higher income people, higher income jobs, it almost always rubs off on the neighborhood communities and actually improves the lives of the people that are actually there. Now, I mean, you could say, is there some displacement effects? I mean, yeah, you can't paper over the negative effects that can be there. But on net, I think any city that if they had to play it over again, where they sort of stopped development, comparing to a sister city that allowed it to continue, they all wish they had continued it because the downstream effects of disinvestment or non-investment. I think in New York, one of the effects of all the various rent regulations that you have a whole bunch of units that the landlord just completely stopped maintenance on, to the point that their strategy for conversion is to get it to the point that they're unlivable, and then they can blank the whole thing, that's not the way we want public policy to work, obviously. And I think that one of the things I think that we all have and who are in this world, be it in technology, is that publish what you have to show what is true when people need to know it. And I think that that's always something that we can. If there's any big failings on data, I think that we keep it too proprietary, and we don't share the obvious things, and then it's you're always fighting us at the whim. So I'm not sure where we are on time, but do we have any questions from the audience or any? I always like to open these things up because I've got a very interesting set of panelists here.
Yeah, no questions yet, but a reminder to everybody that you can submit questions through our app.
Does anyone?
You got a couple more minutes though, guys.
Does anyone want to raise their hand? And I'm putting James on the spot to maybe get you the. I mean, I'll take the last question, and then if no one's good. But I always like to kind of blinded by the lights there. But okay, if there was. I almost feel like, Stefan, you're allowed to answer this, but be careful. If there's a piece of data that exists, if you could put a wish list out to the people like Stefan and all the various startups that are obviously collecting a lot of money to invest into data and to create products that they hope to sell to all the various firms and developers to enhance our businesses, what is the hole? What's missing? What would you love to be available, be it for purchase or be it for free or your own internal development that just isn't there? What's your data wish list?
I can start. I'll speak more so from the capital markets perspective. I think it would be really interesting to know, for example, when different companies are bidding on an asset and then they decide to pull away, like what happens throughout the process, or at one point they were very interested and something happened. I would love to know that type of information more closely, because I think it would definitely add a lot of value in pitching, right? And help us understand what investors are looking for more specifically, versus sometimes it just seems like everyone's going towards the same type, right? But obviously there's nuances to it. So just that strategic mindset, I think that sometimes, it's conversations that happen in a room that sometimes, we're not a part of, right? And it's not that the data is not proving that the asset will perform well. There's something that's off. So it's more of that I would love to have. Yeah.
So after mobile location data, honestly, I'll throw it out there. It's zoning capacity data. I mean, any sort of data that is held by the jurisdiction is all over the place in terms of quality and sufficiency and accuracy and latency and all that sort of stuff. Now, when you think about it from a development perspective, when we're talking about building affordable housing and market rate housing and the interplay between that, one of the biggest challenges is knowing what you can build where and how much. New York City has done a pretty good job at this, at publishing a single number of what's the floor area ratio you can achieve in a development on any particular parcel, but not a single other city, to my knowledge, in the United States has any such data set. And what it does is it forces people to go and engage with architects and engineers and lawyers and consultants and all these people, so the cycle times, even for just evaluating at a cursory level what might be done in order to develop or redevelop a property, it takes forever and it slows the entire market cycle down. So that's number one on my wish
I would just say as a developer, I'd love that data if that existed.
Nice.
Right.
Two things. The first one I'm going to get outside of multifamily world, so forgive me. Actual point-to-point supply chain data on packages. I want to know a package that ends up at your door in Manhattan from a warehouse in the Bronx. I want to know how much time it spent in Harrisburg, and I want to know how much time it spent in Memphis before that, and I want that for as many packages as possible. And then at just a basic level in the resi side of things, actual asset level rent data internationally. I know that this is about using data, but I can't emphasize how good we have it in the U.S. compared to starting to work on these sort of problems overseas. The U.S. is just if I could have good international data, I would be very happy.
So I'll throw one that I've seen people attempt at, and including I think Placer is one that I think at least is in the realm. But I actually like to know sort of hour by hour or percentage occupancy data on all types of things. I think that where we're moving into this, now this is the multifamily room, I get this, but where people are, because there's all, we do office and multifamily, and we think of it as there's a trade-off there, right? If people are working from home, they're in the multifamily space. If they're back in the office, they're obviously commuting, walking, however, getting to the office space. And there's been all this talk about flexibility, 2 days a week, 3 days a week, and then of course, for if you're in office leasing, you're like, well, if you really are a 3-day-a-week company, can you then reduce by 20% or something? And then, of course, if you're that employee, do you now need an extra bedroom in the apartment because you need these are practical questions that we've all probably actually had to live through last thing. And one of the things that I can just keep going back to is that, what office building is 100% packed all the time before the pandemic? Think back to 2019. Some businesses, they were like elbows to elbows like that. Others, people are coming and going and everything, and we weren't really ever tracking this. And the same thing for an apartment. Are people really, and this is the whole thing in New York, oh, well, you don't need to live, you can live in this shoebox simply because, you live in the city. You don't need a space. I've heard these theses from the developers all the time. And I don't really think we think about how much we spend time in each room. How much time do your tenants spend on the balcony? I'm guessing not a lot, but they really want that balcony when they're making a leasing decision. But you probably all know they're not spending an hour out there. They're probably sticking boxes out there or whatever. If we actually knew this, I think our design and our investments could be so much smarter about and I always think the cell phone data does kind of at least get on a very macro level where people are, but even inside the building. And I think that this is something that as we really emerge out of this post-pandemic world and we're trying to enhance our designs, one of the reasons right now where I don't think anybody, and we did a lot of office leasing this year, a lot of it for several years forward projects, but no changes, to be quite honest with you. The architectures, the things that do, as far as we can tell from they're granted these build-outs are still a couple of years away, but we haven't seen any major changes. And I keep asking all of my teams, tell me when you see the real post-pandemic office walk in the door from a design build-out. Call me up, and it hasn't happened yet. I think that every business out there and every person, we just do not know how people are actually utilizing our real estate, how they're physically spending time. And I'll tell you this right now, think about anybody here who lives in a house, owns a house, right? You have rooms in your house, I guarantee you visit less than once a week. But you still value that in what you're going to pay for it. Maybe it's crazy, the game room or whatever it is, the guest bedroom, whatever. And I think we all have this. We have it in our multifamily spaces, our amenity spaces. We have it in our office buildings. And I wish someone could give me an actual data-driven, factual answer about how much time is being, as opposed to everyone's got an anecdotal story. So everybody out there in that business, get to it. And I think we are close to time.
Yes, we are close on time. Thank you, everyone.